In this video, we're going to talk about the exchange of assets, and we're going to discuss how we account for those using the fair value standard, and we're going to also look at the exception to the fair value standard. When you think of an exchange of assets, you might think, oh, I'm going to trade in a used car for a new car. That's not the only kind of exchange that we could have. We could trade one used item for a different used item that's actually a completely different used item. You know, you've heard of the barter economy. Well, we could be doing that too. But this is different from simply disposing of an asset by selling it for cash. When you depreciate an asset for a few years and come up with a book value and then sell it for cash, it's really quite obvious whether you have a gain or a loss on that disposal. And in this video, we're looking at that other concept of exchanging this asset for another asset. So we're not just selling for cash. So a couple of accounting questions come up, and one is, first, should we even record a gain or a loss? So the main standard that we use, as you can see on the screen here, is called the fair value standard. And under that standard, which is the one or the method that we use most times, we are going to value this exchange at the value of the asset that we give up. Now again, so many things in accounting have an exception. The exception to that is if the value of what we're going to receive is more reliable and reliably measurable. But in general, the standard begins with saying we're going to value the transaction at the value of the asset we gave up. And that's the fair value. The other part of the fair value standard is that we will in fact recognize a gain or loss on the exchange of assets. So a monetary transaction here would be you simply selling your used asset for cash. The non-monetary transaction is exchanging your used asset for a different used asset. Now, this does not mean there is zero cash. There can still be cash involved, but the main concept of this transaction is an exchange of assets. Since they're not always valued equally, one of those parties may need to pay cash. So we're going to look at this and an example, and then we're going to look at the exception to this and do an example as well. So here's an idea of the exception. First, if you cannot figure out the fair value of anything, now I know it says 2, but I'm going to look at that one first. You know, IFRS takes a dim view on you not being able to figure out a fair value. So really, you should be able to do this. It's just once, in maybe a few years that you could not figure out a fair value. This is the key one here. The transaction lacks commercial substance. And if it lacks commercial substance, what we're really saying is that you, after this exchange, are in about the same position you were in before the exchange. So this really can be measured, and it's about your future or predicted cash flows from using this equipment or whatever asset you exchanged. So if the amount of your future cash flows, the timing of those cash flows, and the risk involved is about the same, then we're saying there's no real commercial substance to this. You're not changing the sort of how your business is going to do in the future. It's exactly the same. If that's the case, then we do have the exception to the fair value standard, in which case there is no gain recognized. Now, if there's obviously a loss, you do recognize it, but for the most part we won't recognize a gain. So how do we do this without a gain? Well, the new asset that we receive is simply the book value of the asset that you gave up, and that of course would be plus any cash you paid or minus any cash that they paid you. Okay? Now again, this is the exception. Now, one of the things you should just consider is how we could possibly have no commercial substance. Well, first of all, for the amount of cash flows to be the same from using the different asset that you're going to receive, and the risk is the same, and the timing is the same, it needs to be the same kind of asset. So if you have a small, let's say you have a mobile home for your business, like a construction trailer or something, and you trade this construction trailer for a fishing boat. Well, there's no way in the world that these can have the same cash flows, because the cash flows of using your construction trailer versus using your new fishing boat are definitely going to be different. So the only time when you would even consider this transaction to lack commercial substance is if the asset you get is the same thing or very similar to the asset that you give up. So from this alone, you can see why most times we're going to be using the fair value standard. So we're going to do a couple of examples here. So here we're going to exchange a used machine for a new machine. Now when you think about this, a used machine has repair cost, and it may not be as efficient as a new machine. New machine should have warranty. You are going to be in a different position when you trade something used for something new. So this does have commercial substance. Therefore, we will be using the fair value standard. Now, this says that we can figure out the fair value of the new machine. So recall that the default is to use the fair value of what you gave up, unless the fair value of what you receive is a better measure and more reliable. Now in this case, we're saying the value of our used machine is more reliable. I think I said that backwards, but before. But anyway, here it is. The fair value of the used machine, $6,000. We do not have the fair value of the new one. And that's because, of course, you could go to a dealership and they might sell you something for less price. They might give you $1,000 off or $2,000 off. So list price is not necessarily the same as fair value. So we're using the fair value of what we gave up. And the cost of our old machine was 12. Accumulated depreciation is 4. So the book value is 8. Okay, now right away, think about this. If the book value is 8 and the fair value is 6, we have a $2,000 loss on the exchange. It's worth $2,000 less than our book value. Now the other thing that we're doing is we're paying $7,000 cash. So we could calculate this journal entry before we started recording the journal entry. Here's what we're doing. We're giving up two things to get this new equipment. We're giving up old equipment worth $6,000, and we're giving up cash of $7,000. When we add those together, here's what we're getting. We're getting $13,000. And as you may recall from your Introduction to Accounting course, when you dispose of an asset, you need to credit out the historical cost of the asset. So there's our credit of 12 to credit the historical cost. We have to debit out, basically close out to 0, accumulated depreciation. So accumulated depreciation was $4,000. That's a credit balance, of course, so we debit that. Now, just an aside, make sure you bring your depreciation expense up to date on the day of sale. Now, we're going to do that much more extensively in the next chapter, but I just wanted to remind you now that, most times disposing of an asset is 2 journal entries, one to bring depreciation expense up to date, and then one to dispose of the asset. These are sort of focus problems, so we're assuming that depreciation is already up to date. So now, here's our cash credit, and this journal entry works, right? We've taken in $13,000 for the new asset, which is the fair value of 6 that we gave plus the cash of 7. We've closed out our accumulated depreciation. We've recognized our $2,000 loss. We've closed out our equipment account. That's now sitting at 0, at least for that piece of equipment, and we've paid our money. So this is an example of the fair value standard. So let's do another one. Now, you'll notice that in this particular example, we have a number of used trucks, and we're exchanging used trucks for land. These are very different assets. Again, there is no way that you can have, your cash flow from using these assets as the same thing. The amount will be different, the risk will be different, the timing will be different. So this transaction does have commercial substance. Now we're saying that we can calculate the fair value of our trucks. So this is our starting point. Now let's look at our cost and our accumulated depreciation. Our cost is $64,000. Take away accumulated depreciation of 22, and the book value is 42. So right away, let's look at the calculation and say, did we have a gain or a loss? Because remember, the fair value standard means you do calculate and record your gain or loss. So the fair value is 49 and the book value is 42. The difference is $7,000 in our favor, so in fact we do have a $7,000 gain on this exchange. So we're giving up 49 and we're giving up 4,000 cash. Add these together and this determines what we're getting. 49 plus 4, we're going to value the land at 53. Now, in a similar way to the previous example, when you dispose of these trucks, you need to close out accumulated depreciation. So there's our $22,000 debit. You need to close out, basically credit the historical cost of your trucks. That takes them off the books. So these two lines get rid of the asset that we're giving up, and they also get rid of the accumulated depreciation that went with it. Sometimes I see a student mistake. A somewhat common student mistake is to not do this at all, and sometimes students just credit trucks for 42. Now the journal entry will balance, but it's wrong because you're still sitting there with money or a balance in the account for the truck you don't have anymore, and of course you still have accumulated depreciation. So you have to get rid of these two. Now we paid 4,000 and we gained 7. This journal entry now balances, and as you can see, all of these numbers were relatively easy to calculate. If you calculate your numbers first, it's easy to build the journal entry. What about this example? Now, this is a bit of a strange example, but we'll do it anyway. So we're going to exchange a commercial property in Ontario for an almost identical commercial property in Alberta. So first of all, we have the makings here of a possible exception to the fair value standard. We're exchanging one commercial property for another one, and they're almost identical. So, I mean, in a test situation, maybe that's not enough information for you to decide whether there is commercial substance, but in fact, look at this. We're just going to tell you there is no commercial substance. So if there's no commercial substance, then you do not record a gain or a loss. All you do is you carry the book value into that new asset. Now this looks a little more complicated, but it's not too bad. So let's just go through this. We are Wesco. Notice that our book value is $420,000. We don't actually care about the fair value because if there is no commercial substance, we're not going to record a gain or loss. So we're not going to subtract these two numbers and calculate a gain or loss. What we're going to do is we're going to say, okay, the cost was $520, accumulated depreciation is $100,000, giving us a book value of $420. Now we don't have that property anymore. We're trading it for a property in Alberta. So if in fact you don't have it anymore, you have to take it off your books. So these two lines in the journal entry take it off your books. Same as the last two problems, except we don't have a gain or loss. So with these two lines, your property is gone. It says you also paid $30,000 cash. So here's our cash credit. Now, you might be tempted to go, oh, I can do this in my head. $550 in credits, $100 in debits. I'm just going to debit that building for the difference, $450. And well, you'd be right. But let's figure out how we can do this. Just to make sure. We're going to take the book value of the property we're giving up. We're going to add the $30,000 cash that we're paying, and that's the $450,000 debit to the building that we just traded for, the building in Alberta. Okay, so this is our example here of no commercial substance. So again, we're going to use the fair value standard though, unless there is no commercial substance. So let's look at this one, and we're going to do basically, this example and this example. So this won't take too much longer, but I want to make sure you get lots of examples here. So this is a non-monetary exchange. Now you'll notice that we're exchanging a delivery van for a pizza oven. Well, there must be commercial substance. Can't have the same cash flows from a pizza oven as you do from a delivery van. Okay, so right away we're going to have to calculate a gain or loss. We're using the fair value standard. Now it says here that the fair value of the van cannot be reliably determined. Now we're giving up this van, but we don't really know what it's worth, but we can say the oven is worth 6. So this is that situation where we're using the value of what we receive. So here's our $6,000, new oven. Let's look at the van. Historical cost, 24, accumulated depreciation, 16, book value is 8,000. Now we're giving up this van with a book value of 8 to get something with a fair value of 6. Doesn't sound so great for us. So here's the book value. Here's the fair value of what we're receiving. This tells us that we have a loss of $2,000. So if we put this together as a journal entry, we're going to do the same thing we did in the previous problems. Maybe you could try this journal entry on your own. We've done a couple of examples already. If you like, you could pause this video and just do this journal entry on your own. Okay, I hope you did that on your own. So we're getting an oven with a fair value of 6. We're debiting our accumulated depreciation to close that account. You can't have accumulated depreciation on your books for a van that you don't own anymore. We're debiting loss on disposal, and of course we're crediting the original historical cost of the van. Now that all adds up, and this is our second last example in the video. We're using the fair value standard. Okay, so let's look at the exception one more time. So this is obviously kind of a contrived example, but most times we do use the fair value standard. So here's what happens. He has an old Ford delivery van, and he had a bad experience with his Ford, and he's a little bit worried, or he's superstitious, so he decided he wanted to trade in his Ford and buy a Chevy. Now he didn't buy a new Chevy, he just basically traded in a used Ford for a used Chevy. He also had to pay $3,000. Somebody's going to make a profit in here, so he's kind of out of luck. Now, let's have a look at this. This is key. he is in the same economic position as before the trade. All he's doing is delivering with his used delivery van. The amount, the risk, and the timing of cash flows is not going to change. And it's the same asset. It's a van for a van. So therefore, there is no commercial substance in this transaction. Therefore, it is the exception to the fair value standard, and we will not recognize a gain or a loss. All we're going to do is move that book value plus the cash we pay into the new van. Okay, so just a reminder here. Here's our van. This is the van, right? It costs 24 and accumulated depreciation is 16. It's got a book value of 8. Okay, so that's the van that we're trading now for a Chevy. Okay, so here's our book value of 8, which is that cost minus accumulated depreciation. Now we have to get rid of the old van and take in the new one. You cannot keep your accumulated depreciation and your old van historical cost in your account because you don't own it anymore. So we have to get rid of those like we did before, but we're not going to have a gain or loss. Here is the debit to accumulated depreciation. Here's the credit to our historical cost of our Ford van. Here's the $3,000 cash we're paying. And of course, if we're transferring the $8,000 book value plus the $3,000 cash, then we have a calculated amount of $11,000 for this new van, and it actually, the journal entry balances. So that worked. Good news, right? Okay, so we've gone through quite a few examples of exchange of assets using the fair value standard and the exception, which is no commercial substance. So you should be able to do all of those in the homework, hopefully get them exactly right the first time.